Good morning. Welcome. My name is Tijani Onemisi. Science. How we taking you risk management and insurance. Risk management and insurance. You will be given the course outline for this course. We shall talk about the meaning and nature of risk. Of course, the course outline is divided into 5. We have the meaning and nature of risk. We have the meaning and nature of risk. Meaning and nature of risk. We shall also talk about the meaning of risk, the nature of risk, and uncertainty, as well as risk. Secondly, the types of risk. The type of risk confronting businesses, the external risks of a business, and as well as internal risks of a business. For the third one, we'll talk about risk and business stakeholders. Risk and business stakeholders. Under the risk and business stakeholders, we shall cover the stakeholders and business risk, the inside stakeholders and risk, as well as outside stakeholders and risk. And for the fourth unit or module, we have people's attitude to risk. Under the people's attitude to risk, we shall talk about the objective and subjective elements of risk. We shall also talk about objective elements of risk, the subjective elements of risk, individual attitude to risk, relationship between risk aversion and uncertainty. The fifth one is cost associated with risk. Under the cost associated with risk, we shall talk about the cost associated with risk itself, cost in Nigeria, as in cost in nature of risk, the private and social costs inherent in risk, as well as losses arising from risk. We shall begin with the meaning of risk, meaning and nature of risk. The concept of risk is fundamental in the realms of finance, insurance, and various other fields. At its core, risk refers to the uncertainty or probability of an event occurring that could lead to either positive or negative outcome. Simply put, it is the possibility of something going wrong or not as planned. We all know that risk can manifest in various forms, including financial risk, operational risk, strategic risk, and of course, reputational risk, among others. Risk can be defined as the uncertainty or probability probability of an event occurring that could lead to either positive or negative outcomes. Simply put, it is the probability of something going wrong or not as planned. That is the short definition of what risk entails. It can be defined as the uncertainty or probability of an event occurring, of an event happening that could either lead to positive or negative outcomes. Things are meant to happen in life. It could be positive, it could be negative, it could be good or bad. So the event of such happening, or the probability, or the instance which it may happen, it may occur or not, borders around the term risk. And in simple term, it is the probability of something going wrong or not as it is being planned. It may be an organization, it may be an individual. Risk occurs in every situation. Of course, this can manifest in various forms. It could be financial, it could be operational, the strategic, it could be operational or reputational. Among others. Risk can manifest in various forms, be it financial, operational, strategic, or reputational. For the financial risk, it refers to the uncertainty surrounding the potential return on an investment, which includes market risk, which arises from changes in market conditions such as interest rates, exchange rates, and commodity prices. Credit risk as well, which arises from the possibility of default by borrowers or counterparties. And liquidity risk, which arises from the inability to buy or sell assets quickly without significantly affecting their prices. Financial risk refers to the uncertainty surrounding the potential return returns on an investment. It includes market risk, credit risk, and liquidity risk. Now, what does it mean to have a market risk? Market risk which arises from changes in market conditions such as interest rates, exchange rates, and commodity prices. It may go up, it may come down. Inflation, just to mention a few. A credit risk arising from the possibility of default by borrowers or counterparties. At the end of the day, they may decide not to pay, or their inability to meet up with the deadline, with the date given to them to pay up, or the counterparties involved. We also have the liquidity risk, which arises from the inability to buy or sell assets quickly without significantly affecting their prices. Financial risk defined. I want to talk about operational risk. Operational risk refers to the risk associated with the decisions made by an organization regarding its objectives, resources, and competitive positioning. You think operational risk. This type of risk arises from internal processes, systems, or people, and includes the risk of fraud, error, system failures, and other operational issues. This type of risk arises from internal processes systems or people and includes the risk of fraud, errors, system failures, and other operational issues. It can also include legal and compliance risks stemming from violations of laws, regulations, or company policies. These are operational risks. Yes, if you look at every going concern, organizations, banks, insurance companies, multinationals, they all have risk departments. They all have a department that caters for all this. Should there be any form of error, failure that may crop up, the internal system, the audit, all these are significant departments that caters for this should any of such crop up. Again, the operational risk, the type of risk that arises from the internal processes in the in-house errors that happen, systems or people, and the risk of fraud, error, system failures, and other operational issues. The technical department of a going concern, so to speak. The errors that may happen in the process of database while trying to upload the definite document, details of individuals, details of companies, profiling, system failure, be it from the IT department, amongst others. All these are constituents of operational risk. I want to talk about the strategic risk. What do you call a strategic risk? From the word strategy. A strategic risk is that type of risk associated with decisions made. By an organization regarding its objectives. Regarding its objectives, resources, and competitive positioning. It includes risk related to changes in market dynamics. Market dynamics, technological, disruption, competitive pressures, and strategic missteps. Strategic risk refers to the risk associated with decisions made by organizations. You know, whenever an organization wish to embark on what can be done to ensure maybe dominance, to ensure that they acquire probable number of customers, to ensure that they remain dominant in the market, there are certain things they do. All these things put together to ensure that an organization thrives, to ensure the organization ensures it reaches its peak, to ensure that the organization achieves its set target and congruent goals, is called a strategy. Now, with that strategy as well, it also has a risk inherent in its paraphernalia. The risk here is associated with the decisions made, decisions reached by an organization regarding its objectives, its vision, its mission, its values, its organizational culture, its resources, and competitive positioning. Whatever strategy taken today, whatever action taken today, may make or mark a definite going concern. Therefore, it includes risks related to changes in market dynamics. Of course, markets, the environment we have, be it internal or external. And here we're talking about the external as well as the internal, because they're interwoven in one way or the other. Environment is dynamic. It's prone to change. It can change anytime. Market dynamics, technological disruption. An app you use today may become obsolete tomorrow. A software being used by organizations, banks, multinational companies, insurance companies, for their database may become obsolete any moment. There are competitive pressures and there are strategic missteps which may affect the organization in one way or the other if not properly managed. All these are constituents of strategic risk. Reputational risk. A reputational risk arises from the potential damage to an organization's reputation. Arises from the potential damage to an organization's reputation. Or brand value. Due to negative public perception, scandal, ethical lapses, or other adverse events or happenings. It can have far-reaching consequences affecting customer trust, investor confidence, And of course, employee morale. A reputational risk can arise from the potential damage to an organization's reputation or brand value. This is due to negative perception, negative public perception, scandals, ethical lapses, or other adverse events. And we're told that it can have a far-reaching consequences affecting customers' trust, investor confidence, and employee morale. Understanding and managing risk is crucial for individuals, businesses, and institutions to achieve their objectives while minimizing potential losses. Risk management involves identifying, assessing, prioritizing, and mitigating risk through various strategies such as risk avoidance, risk reduction, risk transfer, e.g. insurance, and risk acceptance. In the context of insurance, risk plays a central role. Insurance is essentially a mechanism for transferring risk from an individual or entity, the insured, to an insurance company, which is also known as the insurer, in exchange for payment of a premium. Insurance pools the risk of many policyholders and use statistical analysis to spread the financial impact of losses across the pool. This enables individuals and businesses to protect themselves against the financial consequences of uncertain events such as accidents, illnesses, natural disasters, or other unforeseen circumstances. Risk management involves identifying, assessing, prioritizing, and mitigating risk through various strategies. Strategies such as risk avoidance, risk reduction, risk transfer, and risk acceptance. This is the definition of risk management. It involves identifying, assessing, prioritizing, and mitigating risk through various strategies. Strategies such as risk avoidance, risk reduction, risk transfer, and risk acceptance. In summary, Risk encompasses the uncertainty inherent in various activities and decisions and can have significant implications for individuals, businesses, and society as a whole. Effective risk management and insurance mechanisms are essential for mitigating potential losses and ensuring financial stability and security. There's something we call systemic risk. It's a type of risk and ensures that the possibility of widespread financial instability or collapse within an entire system or market is easily forestalled. It's a type of risk, or should we say this type of risk refers to the possibility of widespread financial instability or collapse within an entire system or market. It often arises from interconnectedness and interdependencies among financial institutions, markets, and economies. Systemic risk can result from factors such as contagion effects, regulatory failures, or macroeconomic shocks. Examples include the global financial crisis of 2008, where the failure of large financial institutions triggered a domino effect throughout the financial system. Essentially, apart from these four we are highlighted here, which risk can manifest in various forms: the financial, operational, strategic, and reputational. We want to talk about other instances, other forms, not limited to financial, operational, strategic, and reputational. Systemic risk. This type of risk refers to the possibility of widespread financial instability or collapse within an entire system or market. That is the definition of systemic risk. We're also told that it often arises from interconnectedness and interdependencies among financial institutions, markets, and economies. It can result from factors such as contagion effects, regulatory failures, or macroeconomic shocks. We'll give it an example. A very good example is that which happened, the global financial crisis of 2008, where the failure of large financial institutions triggered a domino effect throughout the financial system in Nigeria. The natural catastrophe risk is another one. to natural catastrophe risk. Natural disasters such as earthquakes, hurricanes, floods, and wildfire pose significant risk to communities, businesses, and governments. These events can cause widespread damage, loss of life, and economic disruption. Insurance plays a crucial role in providing financial protection against such risks through specialized products like property insurance, business interruption insurance, and catastrophe bonds. However, accurately assessing and pricing natural catastrophe risk can be challenging due to factors like changing climate patterns and evolving exposure concentration. From the word natural catastrophe risk, it's a catastrophe. It is a natural disaster that can happen, that happens. Events such as earthquakes, volcanoes, hurricanes, floods, and wildfire. They all pose a significant risk to communities, business. It is worrisome to government as well. These events can cause widespread damage, loss of life, and economic disruption. The role of insurance is to ensure that the provision of financial protection against such risks through specialized products, through specialized policies to cover or cater for this disruption arising from natural disasters. And wildfires pose significant risk to communities. It poses a significant risk to communities, businesses, and governments. Why? Because these events can cause widespread damage. Can cause widespread damage, loss of life, and economic disruption. Now, this risk has occurred, may occur. The purpose of insurance or risk management is crucial in providing financial protection against such risks through specialized products like property insurance, business interruption insurance, and catastrophe bonds. However, accurately assessing and pricing natural catastrophe risk can be challenging due to factors like changing climate patterns and evolving exposure concentration. We have the environmental, social, and governance. Risk. The environmental, social, and governance risk. The acronym is ESG. Environmental degradation, social unrest, and governance failure. Present emerging risks for businesses and investors. Again, environmental degradation, social unrest, and governance failure present emerging risks for businesses and investors. Climate change related risks such as extreme weather events, regulatory changes, and transition risks associated with a shift to a low carbon economy are increasingly relevant. Social risks include issues like labor practices, human rights violations, and community relations. Governance risks encompasses issues such as board diversity, executive compensation, and regulatory compliance. Integrating ESG factors into risk management frameworks and investment decisions is becoming essential for sustainable business practices and long-term value creation. The explanation of risk management is to identify the purpose. The primary objective is to identify, to assess, to prioritize, and mitigate risk through various strategies such as the risk avoidance, the risk reduction, risk transfer, and risk acceptance. All these are necessary to guard against the event of, or the probability of an event happening. We talked about risk to be the uncertainty or probability of an event occurring that could lead to either positive or negative outcomes. And we also say that risk can manifest in various forms: financial, operational, strategic, and reputational. We have defined them. We also defined risk management. We went further to itemize, to explain other forms, other manifestations of risk happening. We said risk can manifest in various forms. We have mentioned and explained the financial, operational, strategic, and reputational. We are moving forward. There are other forms in which risk can manifest. We talked about the systemic, we talked about the natural catastrophic risk, and now we are under environmental, social, and governance risk. On our next meeting, we shall dwell more on other forms in which risk can manifest. Thank you all for listening.